Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, Chris Burbach is back with us. He's a co-founder over at Fundamental Income. We're going to take a look at income plays for a low interest rate environment. And Chris, this is perfect timing. We just got the announcement that they are going to leave rates unchanged, pretty much so expected. But let's talk about different ways to derive some income in this kind of environment. REITs. That's a really big part of, $75 billion are in REIT-focused ETFs.
Yeah, absolutely. And when you look at what the options are for investors in today's market, when you have fixed income products that are yielding really low sub-3 type of interest rates overall and yields, and a stock market that's struggling to find growth, REITs are a great total return alternative for you, and certain segments are better than others, but at the same time, the REITs overall are a great way to get income, but also growth through the rents and some other ways to grow cash flow.
All right, now there's more than just one kind of REIT, net lease REITs. Tell us about those and how they're different from what you would traditionally think of as a REIT.
Yeah, certainly. So net lease REITs are companies that own real estate that's leased to operating companies or single tenants. So there are 23 of them on the market. It's about 11% of the overall REIT market. It is a segment of the market that is, while it's only 11%, it still represents over 23,000 properties. It's diversified across industries, and you can think of tenants like Amazon or Walmart are big users of net lease, and because of the way that they lease properties to the tenant, they are collecting the rent, but the tenants are also responsible for paying all of the rent and the property expenses. And so it gives you a really good idea of what kind of cash flow you can expect from them.
All right, now one ways that you can get access to a net lease REIT is through NETL.
Yeah, exactly.
Right?
So we launched NETL in March with our partners, and it's a great way to access the entire sector. All 23 properties are included. It rebalances quarterly. And it's something that when you look at the overall market, it's a great way to play a diversified way of getting into the U.S. consumer.
Right, and that was my question too. With diversification, let's say, these are big names like Amazon and Walmart and Starbucks. What if someone who's leasing one of those properties defaults? Is there enough diversification within the portfolio to not impact the REIT that much?
Yeah, absolutely. So one of the reasons you want to play it as an ETF is that this is diversified across 23 companies, but also within each of these companies, they're highly diversified. They have portfolios of properties that are leased to a number of different tenants. The way that we've constructed our index, that is the backbone of the ETF, we put constraints around concentration in specific tenants. And so what you get is a really, really diversified way of getting access to different tenants in the U.S. economy.
Does geography come into play at all?
It does. It naturally just, it's pretty much any kind of freestanding building. And so it's all across the United States. And it's basically, all 50 states, and there isn't really one particular state that dominates one or the other.
All right, now when you talk about portfolio management, is this something that you would have to complement other parts of your portfolio, or is it something you could just invest in and use it as like a dividend generator? Yeah,
it's a segment of the market that trades lower than the overall REIT market. So it's a value-oriented play within the REIT space. It's something that gives you a slightly higher dividend because of that, but it's often misunderstood as an alternative to a bond. The reality is that net lease REITs have a number of ways, different ways of growing cash flow, and so it's something that gives you a value-oriented way of getting income, but also capital preservation through the growth that they.
So it fluctuates. It's not just like a bond. Okay, here's the dollar amount, and that's it, and you move on. It has a way to fluctuate.
Yeah, exactly. You have management teams that are actively managing the portfolios. You have rent growth within each of the leases, but they also, because the tenants are responsible for paying all of their property expenses, they have a lot of free cash flow to go reinvest in new assets. They also can raise new capital and invest it at yields that are higher than where they trade. And so all of those factors add up to a total return that's pretty compelling in today's market.
What's the average yield?
So the average yield on the index of the 23 companies is about 4.9%.
Oh, certainly better.
And after management fees, it's kind of in the low to mid fours. But along with that, it has growth that's consistent with, from a cash flow perspective, that's consistent with the overall REIT market that gets you up into a double-digit total return.
All right, Chris, thanks so much for joining us.
Thank you so much for having me.
And thank you for joining me on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.